Joining us now is Evan Connell, Director of Engagement and Activation at Canada Life. His session is Insurance as a Philanthropic Planning Tool. You can expect to learn how the MyPar gift can help clients leave a lasting legacy with a single premium.
Good morning, everybody. As Jonathan had said, thank you so much for your time today to go through what I think is actually really an opportune time to have a conversation around charitable giving and really a unique solution that we have at Canada Life through MyPar Gift. So as Jonathan said, my name is Evan Connell. I've been connected to not only the development of the product, but also the market activation. So working with advisors such as yourselves that are on the line right now, but also importantly, working with charities directly. Because what you'll see throughout this presentation is it is a unique solution. And what I'd say to start off is it's not a solution for everybody. It is a solution that's something for a very particular client and what their needs are, what their philanthropic goals are. But also from an advisor's perspective, it's not meant to be the end all and be all for all insurance gifts that it should now be MyPar Gift. It is a new tool on the tool belt to have a conversation, maybe with your clients that you might think they may not be involved in philanthropic giving, to at least to bring that conversation forward. And I've seen over the last almost 3 years since we launched the solution, the opportunities that have arisen by advisors taking that chance or taking that effort to reach out to their clients to see if philanthropy is something that is a part of their financial plan. And I'd say there's been a lot of learnings through the product development, but also through the launch. When we initially were launching this solution, we saw it as really something that focused in the high net worth and ultra high net worth. And I'm going to go through some feedback and also some learnings around it isn't necessarily that. It definitely is a solution that fits with those that have maybe a tax liability or they're looking to offset tax liability in the future through philanthropic giving. There is a solution there with MyPar Gift, but also those I'd say in mid to upper mid market, there is an opportunity with MyPar Gift. And it's really around what you see on the screen, simplicity. Other key point, the reason I say it's an opportune time, November is the busiest month for philanthropic giving. There is actually November 15th is National Philanthropy Day. You'll see that Canada Life is very active in the philanthropic space, and we're going to have marketing promos that really speak to MyPar Gift and where insurance and other financial tools fit within charitable giving. But I thought a good point to start off with, what's interesting is when we launched this solution, I don't know for those that were on maybe a call similar to this in the spring of would have been 2023, I believe, or 2022, time flies. When we launched the product, I was going through just the initial pitch of what the solution looks like. So what's interesting with the presentation today is that I'm going to go through not only just what the product is, but also what are we hearing from advisors like you, but also from charities? Because in charities, as I mentioned before, are an important stakeholder in the conversation around MyPar Gift or charitable giving in general. Here's just a few quotes that we've seen since the launch of the product and really some successes that we've seen. So the big takeaways are it's a game changer for charities. After running that session with you folks and running a few sessions with some advisors that specialize in the charitable space, I have seen the fact that it's a game changer. It's a conversation starter. It's a different solution where individuals, philanthropic clients, or advisors look at insurance as something that can add complexity to making charitable gifts. And that's the difference with this solution. Other options that we see here or other feedback is from the charities directly. They're excited. And the one thing that I'd leave this group with, there's a couple things, but one of the main points is there aren't enough advisors that are involved right now in the charitable space. When I'm working with charities directly, onboarding them with the solution, making them aware of it, the question at the end is, product seems great. I see where there could be an opportunity with some of our philanthropic clients. What's the next step? And the next step is a financial advisor needs to be connected to all MyPar Gift or really any gifts of insurance. So they're looking to partner with folks like yourselves. And this could be organizations as large as if it is like universities down in Toronto and Montreal, hospitals, major hospitals. Sick Kids is another organization that I've been closely connected with. Sick Kids is a bit unique that they have philanthropic council with insurance advisors connect to it. But I'd say that's one of the very few exceptions across Canada. A lot of these charities are looking to partner with folks such as yourself to approach their charitable clients with new solutions. And this is that conversation starter. And that's the other big piece. The one last quote that I'd touch on here, and it comes down to when we developed the product, very close relationship with an organization called the Canadian Association of Gift Planners. You see that in the bottom right-hand corner, CAGP. So they are involved with both the charitable sector, but also financial advisors, and they're advocates in the philanthropic space, and they're very well known. So having that for us, when we initially launched the product, the fact that we had CAGP connected to the product launch, but also to the ongoing activation and launching in market, it has really driven some credibility behind us. We're not seen as the insurance carrier looking at just launching another product. It's something where we're looking to partner, and that's a key piece of this solution too. So I touched on this before, the comment around, is this a high net worth solution only? Initially, our hypothesis was yes, that is the case. But as you can see, of 24% of the sales as of the summer of this year were over $100,000. So is there a space for this in the ultra high net worth or high net worth space? Absolutely. Is there a space for this in those that aren't in that space? Absolutely. The minimum premium amount, and we do go by premium or donation amount for My Par Gift, is $10,000, and there is no maximum. So if you think of that from a mid-market to upper mid-market, $10,000 as a single deposit, and that's the key piece with this, so a single donation, is something that can be attainable by more people, more Canadians, and that's where we're excited about this. Other common question that I get, and I'm going to kind of build the presentation around objections or questions that I typically receive when I'm delivering a presentation such as this to an audience like this is, how's it going? What kind of success are you seeing? And you can see the growth there, significant growth year over year. What I'd say is we started off small. It took time to get the ball rolling, to get really awareness out in the marketplace around My Par Gift. And we've seen tremendous success. What it really takes is an advisor having success and then approaching more clients, and you can continue to see that momentum grow. The other key piece is really where have we seen success and what charity types? Another question that we get. Is it all, usually we get questions, is it all university or medical gifts or anything like that? There's private gifts. We're going to talk to a unique opportunity with donor advised funds. Again, an opportunity for you as advisors to give your clients more control. But in the private sector, significant opportunities. The biggest opportunities in the seven-figure range that we have seen have been in the universities, people that are making substantial gifts. We'll go through a bit of a case study on what that looks like. But I'd say it's the gamut. It's not really ultra high net worth only, and it's not focused on one particular sector. It really is across the board, all across Canada, and it's an opportunity to open the conversation. And as I said at the beginning, one of the other takeaways is this isn't the only solution. It's a new solution. And as much efforts as myself and my wholesale colleagues have made across Canada to get awareness out in the marketplace, there still is opportunity to do more. So taking it upon yourself to have conversations with your charities, your local charities or national charities around the solution that we're going to talk about, can position yourselves as that subject matter expert amongst your peers. So let's get into the solution. Let's go through maybe some slides you might have seen in the past, but what is My Par Gift? Why is it different? Why am I excited to talk to you today? And why are charities excited? So it's innovative. So it is the first Canadian insurance solution that's specifically developed or exclusively developed for the charitable sector. I'll touch on what that is exactly in just a moment. It's simple. That's the other key takeaway for this. The simplicity is as simple as it's a single deposit. So it's a participating solution, as your group is familiar with, a traditional participating solution. What's different with this product is that it's a single deposit. Once that deposit or donation is made, the product, it is paid up. There is no circumstance, and this is an important point that I'll touch on the next slide when I'm going through feedback from charities, is there's no circumstance where we're coming back saying, you know what, your product hasn't achieved a particular interest assumption, so you need to put more into it, because that does happen, and that can be extremely challenging, obviously for the donor, but also for the advisor, and even more so for the charity. So this product is paid up after that single deposit is made. The last takeaway or value proposition for this solution is that it's tailored. tailored in that we worked with the charitable sector directly around not just the fact that we wanted a simplified solution. So we have kind of a new story to deliver, but it's also tailored in that the onboarding experience is significantly simplified, specifically financial underwriting. I'll touch on that on the next slide, but traditional gifts of insurance, you had to show a past history of gifting from a financial underwriting perspective. Where we've made my par gift different is we've worked with reinsurers, and because you're making that single deposit, the simple act of gifting my par gift is sufficient history, so you don't have to show that past history of gifting from a financial underwriting perspective. And it all comes down to when we developed the product about 5 years ago, and it took about 2 years of product development working with advisors, are what are those pain points? And what we heard loud and clear, as you can see on the screen from advisors, is that adage of fitting a square peg into a round hole. So really the solutions that we have traditionally with insurance is either looking at maybe a universal life solution or a participating solution that could be under, for UL, it might be under a rate assumption. As long as your deposit hits this rate assumption, it will continue to be paid up. And if that doesn't happen, that's the example I gave before, that can cause a friction point for the charities. So number one, we needed to address that. Or from a participating perspective is maybe it's under an offset assumption. So you put in 10 deposits towards an insurance gift that you're giving to the charity. Is that offset supportable? So what we heard from those that specialize, advisors in the charitable space, is we need to address that head on. If we're not able to address it, it's a non-starter. So that was number one, our task that we had to address. So it needed to be simplified from a deposit perspective. Financial underwriting I spoke to. So it's challenging traditionally with traditional gifts of insurance. So that's something to consider as well. With this solution where we've changed it is we worked with reinsurers to make that, as I said before, the simple act of giving a MyPar gift satisfies the financial underwriting kind of history of gifting to the charity. So it simplifies that process. The other key piece with this solution is in-force policies. So there's a lot of focus around new sales, new business. What we heard from advisors and from charities is you need to take it a step further. And I'll give you an example when we were developing the solution, what was given to us from a particular charity. So Canada Life, one of our main campuses, where the campus that I reside in is in London, Ontario. University of Western Ontario was under NDA when we developed the solution. They were more than happy to share with us the negative experiences they have with insurance gifts. Being a university in a city where Canada Life or London Life previously was a very well-known provider, there's a lot of insurance gifts that they're provided, and they shared a lot of the friction or challenges that they have. One of the it sounds very simple to this group, but it's a huge challenge for Western, but also other charities, and I've heard it from them directly, is simple things like on an annual basis, if they're gifted a product that has a cash value, they need to account for that cash value on their balance sheets on an annual basis. The act of contacting Canada Life or other carriers to get those balances can be extremely challenging. And it really, in some cases, when we dug down into what the challenge is, it's as simple as you need to deal with somebody with signing authority. That individual typically could be listed as the president or CEO of the charity. For Western, that's what it was. So in order to pull up policy information, there was a need to speak with the president of the charity. Now, as you could imagine, their time is limited. It's very difficult. So what we heard from advisors and from the charity is you need to make that better. And what we've done, and again, it sounds simple, but if I had a charity audience on right now, you'd see the hands clapping, is we've expanded that list. So we're working with the charities directly to make sure that those that contact us for in-force servicing, we've simplified that solution. And that's a key point. I'll touch on that in the next slide when we go through product design. But as I said, charity is very important for this solution. And I'll leave it as that until we get to the next slide. The insurance baggage problem, I touched on it briefly before, but charities in general, they feel a bit burned by gifts of insurance. They're happy to receive them, but in many cases, if you're working with the philanthropic teams, if there is one at a charity, they'll speak to some really horror stories that they've had with past gifts of insurance. Horror stories around, again, not just getting cash value balances, but policies that have been enforced for 30 or 40 years under a rate assumption that isn't achieved. And now they're stuck with a statement coming to the charity saying this policy is about to fall offside. There is a need for additional deposits to keep the policy in force. And essentially to the charity, the question is, what do we want to do? There is a significant amount of funding that has gone in from the donor to the solution. What do we do? And usually, sadly, the conversation is when an individual is very late on into their life. Um, Sorry, something just came up in front of me here. So it's something that comes up very late into somebody's life. So it can be challenging if you're having a conversation with somebody in their mid to late 80s to say, we need you to put more into this policy to keep it on side. And the charity, if they're not willing, and understandably so, to have that conversation, then they're having to come up with that funding within the charity. And again, dollars are limited. They're using the gifts that they're provided in the active business of the charity. So it can be challenging for them. So again, the pain point, the reason charities are very open to having a conversation with us is not only to have a new story, but also to simplify for them that whole process of gifting insurance. Because of, again, it's as simple as that single deposit. My par gift, it is a par solution that we all are familiar with. The difference is it functions like a gift of insurance or a gift of appreciated securities, which we'll touch on in just a moment. But the complexity piece is another one. Insurance, we love our bells and whistles on products. What we did with My Par Gift, based on the feedback from advisors and charities, is simplifying the value proposition. All the riders and benefits that traditionally are available on regular individual or corporate insurance products isn't available on this solution because it just gets too complicated. And really, simply, they're not appropriate for what we're trying to achieve with My Par Gift. And then I spoke to the servicing challenges as well. So really, that was kind of our marching orders about 5 years ago when we were developing the solution. Is we need to address these points head on in order to be successful in the market, and we are seeing success. But let's step through some details on actually the product design and some of the unique nuances. So the first question that I get, and you see it at the top of the screen here, is donor pays a one-time insurance premium. I touched on that. That's really the big takeaway for this product is it's a single pay solution. So why is that unique and how are we able to achieve it? Common question that I get if I was in front of an audience right now is, why don't other providers offer a single pay par product? And the reason for that, and this is one of the key pieces, I touched on it in the value proposition, why this product is exclusively designed for the charitable sector is in order for us to have a single deposit, the product is what's considered a non-exempt solution, non-exempt from tax. So when we developed the solution, we had to see how could we make this more favorable for donors? How can we make it attractive? Because if you're being taxed on an annual basis based on the growth within the product, that's not going to be attractive. So the way that we set it up is that from day one, after the donor makes their deposit, the product is owned by the charity directly from day one. So the charity is the owner, and that's the key piece. So what I touched on before, why we're addressing the servicing challenges, not only that it needed to be done, but also the charity is the owner from day one. There is no transfer from an individual once the policy is set up over to the charity. When the application is being filled out and when the AML paperwork is being filled out, the charity's at the table. So what's different for you as a financial advisor is they're another stakeholder. When you're having a conversation with your client, we're going to step through a case study in just a few slides. But when you are, it's a conversation with your donor clients around what are we trying to achieve? Once you land on, you know what, we're looking for a simplified solution, but we're also looking to enhance our benefits. We're trying to maximize maybe the death benefit or estate benefit or death benefit, I'd say, that is gifted out to the charity. My Par Gift could be a great solution for them. Then it's the conversation of bringing in the charity to say, this is what we're trying to achieve. Here is where My Par Gift can be a great solution for my client, but also for you from a simplicities perspective. And also there's some unique aspects from a cash perspective within the solution. So it's really bringing the charity in. They are a part of the conversation from day one. So that's why we wanted to be respectful and aware and cognizant of the needs of the charity since they're such an important stakeholder. Because the policy is owned by the charity at day one, tax receipting happens immediately. So again, the conversation I had at the beginning is, My Par Gift may not be for everybody. Are they looking for that tax receipt on their estate? If that's the case, then this isn't the solution for them. If they're looking to cover a tax liability today, and where we've seen success is particularly in the corporate industry for corporate insurance solutions, is individuals that are involved in real estate and have a large liquidity event where a big tax bill hits, they need to provide some tax relief today. And they are, again, the other catch with this is it's a client that's philanthropic, that is looking to give back, but also looking to offset their taxes. So if you're looking for the tax receipting today, that is how my per gift would function. And that's because the charity is the owner from day one. So another objection that I get though from charities around this and even from advisors is, does a charity really want to wait the next 30 to 40 years to realize the benefit of the gift of the insurance? And I'd say the answer to that is it depends. Some charities, especially larger ones, are focused more on legacy gifts. Smaller charities are focused on cash coming in on a daily basis or on a regular basis that they can account for and plan for. What's great about my par gift is it's something that can achieve both of those end goals. So it is par. So as we're all familiar with, being par, there's a cash value component, and we're going to look at what the numbers look like for that. But there is also a death benefit piece. Cash value, because the charity owns the policy, they're able to access that cash. And what's interesting, because the charity owns it and the charity is an entity that's exempt from tax, there's some unique characteristics that you wouldn't normally position with an individual client or a corporate client. One of those being cash dividends. So on an annual basis, if a client is looking for, client being the charity, a simple way to get money out to the charity that they can use in their day-to-day operations, cash dividends can be a simple solution. So every year there's a locked-in death benefit, and then every year, either if it's paid up additions, that death benefit's going to grow. But once that charity wants to turn on the tap and have cash automatically paid out on an annual basis to them, it can be as simple as charity contacting Canada Life to switch the dividend option to cash dividends. So for those that have objections around the charity doesn't want to wait 30, 40 years to realize benefits today, or maybe the donor doesn't want to, there are ways that we could structure the product to help to achieve both goals. Another option that I've heard, and this is me stealing a phrase from a very successful advisor in the GTA around how they position insurance, is blended gifts. Do you need to give, if it's a $500,000 gift, does it all need to go to the insurance? Or could you take a portion of that $500,000 towards my par gift as a legacy solution, and then the remaining amount be paid out directly today? And that's the case study that we're going to look at in just a moment. So again, building the presentation all around objections is, the next question is, does a donor really want to tie themselves to a charity, one charity, for the next 30 or 40 years? I'll give the example for myself. Today I'm in Kitchener. I live in Kitchener, but I actually am from Winnipeg originally. Winnipeg's where my roots are and my family is. If I was to give to the Kitchener Community Foundation today, am I going to continue to live in Kitchener for the next 30 or 40 years? Some donors have concerns around having it tied to that particular charity, or maybe they have concerns around whether relationships might break down, or is the goals of the foundation going to align with them 30 or 40 years in the future? Or other questions that I've gotten very regularly is, what if the charity dissolves? What happens then? What happens to the gift of the insurance? If it did dissolve, again, remember the charity is the owner and they are in control. They could cancel the policy, they could cash it out. But what I'm here to tell you about that fits extremely nicely with my par gift is donor advised funds. So donor advised funds, for those that aren't familiar, and I'm sure many of you are, is a wealth solution that basically it's a wealth product that acts as a charity. So it is a product that is considered a charitable solution where the client can gift insurance into it. And once the insurance is gifted to it, it's similar to just shift out. If it's sick kids, replace that with the client or the Evan Connell donor advised fund at whatever particular financial institution that you have it. The benefit for me, if it's tied to that donor advised fund, the benefit is in the name. Donor advised fund. Donor is advising how the money will be distributed into the future. So for a client such as myself that might move back to Winnipeg in the future, maybe doesn't have ties to Kitchener, donor advised funds can be a great solution to give me flexibility, but also realize the benefits of my par gift and the tax advantages of insurance gifts today rather than in the future. The other key piece with this is really the opportunity to direct disbursements, meaning money that could be paid out throughout the lifetime of the insurance product. So if I had a donor advised fund and I wanted to, let's say, cash out a portion of the cash value to pay it out or disperse to a particular charity in my community, I have that flexibility. The benefit for you as an advisor is you manage the donor advised fund. Once the donor is to pass away, sounds morbid, but once they are to pass, that money flows into the donor advised fund. And depending on how the donor provide direction around how they wanted those proceeds to be paid out, you are now managing that asset for the next generation to be paid out. So from an advisor's perspective, there's huge opportunity with not only having a simplified solution, but for your donors, especially in the ultra high net worth space that want to maintain control, donor advised funds can be a great solution for them. Other key piece, it's not specific to charity, to my par gift, but another piece when I'm speaking with an accounting audience, what's different about life insurance and really a key hot button item for charities is disbursement quota. So on an annual basis, charities have to disperse a certain amount of their assets to maintain their tax exempt status. What's different about life insurance, as long as the cash resides or the product remains intact, if you haven't stripped out cash out of it, it is exempt from that disbursement quota. So for charities, I spoke to donors who like the idea of control. Charities like control even further. They don't like being forced to have to disperse towards, I guess, activities or things that are happening in their community unless they are planned. Insurance continues to put them into the driver's seat. And it's not specific to my par gift. It's just something different around life insurance. And really the theme of what you'll see once you have conversations with charities is there's a huge education gap right now with insurance gifts in the charitable sector. And there's an opportunity for you to bring some knowledge to charities, but also your centers of influences, whether it be legal practices or accounting practices around really where insurance is different and how it can complement what clients are doing currently. And that's a key point, complementing. So maybe you have a client that already is making gifts on an annual basis that you're aware of. This could be something that could complement rather than let's say making a $20,000 donation to a particular community foundation for your client. Why don't we look at taking a year off the direct donation and look at my par gift? Again, thinking of that blended gift that I brought up before, how to enhance that money for their legacy. And it's very important for this sector. So getting a little bit deeper, a lot of text on the screen, but I'll guide your eye to what's green on the screen. I'm colorblind. I think it's green. It's somewhat green. So I touched on a lot of the number of the points earlier. So my par gift where it's different is number one, it's non-exempt. Traditional insurance is designed to be tax exempt. Why that's important is it allows us to make a single premium product. Where it's also important is the growth characteristics within this product are unique in that we didn't just take a traditional 20 pay or life pay and squish it down to a single year. That would be using a product that was designed to be tax exempt. No, we're taking advantage of the fact that this product is designed to be non-exempt. So the growth characteristics, not only because you're putting all the money, the premium in at one point in time, but also the growth characteristics exceed that of our insurance shelf at Canada Life and that of our competitors in many cases. So again, it's a conversation, and actually I'm running to another call with an advisor after this from the IDC group as well to have a conversation around where my par gift can be a fit. Again, it's not for everybody, but there can be a good solution for it. It is available on a single and joint life basis. Question I get commonly is individuals that are looking at making major gifts are typically later on in their life. So viability of the client from an insurance perspective is a question that I get. So two counterpoints to that is number one, this can be set up as a joint last to die contract. So for individuals that are in there, as you can see, the age range is 18 to 75. Once you get north of 70, I'd say the benefits start to dwindle, to be quite honest. But if you're looking at a joint contract, two 70-year-olds, the equivalent age that you would get is roughly about a 60-year-old male non-smoker. So it can be viable for them. So for those that look at it and say, I have two clients that are in good health, but they're at 73. Is this an option that could be a good fit for them? I wouldn't say a blanket statement that yes, it will be a fit for everybody, but there's a conversation to be had there, and joint last to die can be a good solution for them. Another option is if you have any term insurance on your books right now. So if you have term insurance with London Life, Canada Life, or Great-West Life, you can convert that solution depending on the age of the product. Again, have a conversation with your wholesaler or myself if you have any questions. Term insurance can be converted to this. So this is, to take a bit of a step back, This is life insurance. It is non-exempt, but it still is underwritten as a traditional insurance product. So medical underwriting, as I said, financial underwriting is simplified, but this is a medically underwritten product. And if you're looking at a substantial gift, as you can appreciate, like a traditional participating life insurance product, there's substantial medical underwriting that has to go through this. And in some cases, if you have a client that's looking at making a major gift, they might have a health circumstance that may not make them eligible for my par gift. But if they had term insurance that exists, there's an opportunity to convert it over into this solution to provide them that flexibility. As I spoke to before around complexity, we simplified it. We stripped out all the riders and benefits. There is no ADO on this. That's something that we've heard feedback on is one of the downsides of the solution is that once you make that single deposit, there's literally no way to put more into it. If you're wanting to put more into it, the way that I've positioned it is set up term insurance, carve out a portion of it, convert it out into my par gift, and next year or in future years, if they want to set up another my par gift for that same charity or other charities, they could carve out another portion of that term insurance. The downside is you're paying rates at the attained age. So as they get older, obviously it gets more expensive. The reason I bring up ADO is where we've had feedback is people that want to put more into it, ADO could be a solution. I'd say we're looking for feedback. So please share it with, if you have an opportunity to share it with myself or with your specialists locally or your wholesale partners, please pass us that feedback if that is something that you're looking for. Because again, with this product, as I've seen over the last 5 years since we developed and launched it, is this is an evolving story. We've gotten feedback from advisors. We've changed the value proposition to make it easier from an AML perspective, but we're not going anywhere. So we continue to look for your feedback on what makes this work best. One other option that I'll speak to, and when I look at the numbers, is what's the end result of the solution? Dividend option, as I said, is paid up additions or cash dividends. One of the other options is enhancement. And I'm going to speak to that in just a moment. It's in kind of a unique case study that we worked through. So this is just an example looking at paid up additions. This is a 50-year-old male non-smoker. Again, forgive me with colors. The red line is death benefit. The blue line at the bottom is the cash value. So as you can see at year one, the $100,000 donation, so you get a tax receipt initially for the $100,000. So net out of pocket would be about 50 grand, just to simplify numbers. But you get a guaranteed death benefit of $160,000. So you get that immediate lift. And that's something that the charity gets, they start to sit forward, they get very excited about. Cash value equivalent, the cash value break even period. So the point at which the total cash value equates to the donated gift is year 8. What you're seeing here is the red line is at life expectancy, so age 90 for this 50-year-old. The death benefit payout would be $726,000 under our current dividend scale, or 5.1% from an IRR perspective. Or if you're looking at this for joint last to die, the death benefit gets a $118,000 lift on that 726. So about, let's say, $840,000. So for two 50-year-olds, male, female, joint last to die, you'd see that lift, and you'd see also a corresponding increase in the IRR. But the way that this is talked about differently with charities, and what I've really stolen from those that specialize in the charitable sector, is they talk about the benefit multiplier. And as you can see, you're getting at life expectancy, roughly a 7x multiplier on the original gift that you provided. If you looked at it, the gross the actual out of pocket, when you take into account the tax receipting, then you can double that. So it is a significant increase in the original gift. So for those that are looking at maximizing that future death benefit, this is truly a legacy gift. This is how it can be structured. Now let's look at this a little bit differently, and I'll give you actually a bit of a case study or where I've seen success with this. And it actually resulted in a 7+ figure opportunity that we closed about 1.5 years ago. And it wasn't the number, obviously, that you see on the screen right now. But what the objective was, and this was shortly after launching the product, and it took about 1.5 years to work with the clients and the charity to get this put in place, is the goal of the client was naming recognition. They were looking at how do we take a donation, and it was a $1 million+ donation that they were looking at making. How do we take that to the threshold of this particular university where we will get essentially what they were looking for is their name on a building? So these are ultra high net worth individuals that are very connected in their charitable space in their community, and they were looking for getting that recognition. They were also looking to offset some tax liability that they had as a result of a big liquidity event that just happened. So the question, and this was what was different, was the charity approached us, or the university, to say, we like My Par Gift, we like the simplicity, we have these donor clients that are looking to get their dollars go further. What do you have that can help to achieve those goals? And we're also looking for some liquidity. The reason I bring that up in this example is what you'll notice with the red line is it starts off and it's kind of levelized for about 15 years. The reason for that is we're using the enhancement dividend option. So you're buying a bit of term insurance. Remember, the original guaranteed death benefit on the previous slide was about $160,000. By adding that enhancement, I took that amount up to $300,000, just over $300,000. So where this is different is for these clients that were looking at making that substantial gift in the millions of dollars, was they needed to hit a threshold, not getting into specifics around the premium amount, but the threshold was $6 million that they needed to actually get their name onto the building. So we needed to hit that mark. The gift was, again, divisible by about 2 or 3 of that. So they needed that money to get there from day one to get that recognition. They wanted to see the recognition today, but they also wanted to benefit the charity in the future. So the difference with My Par Gift, and this scales, as you know, with participating life insurance, is that they can make that gift in the single digit millions. At life expectancy, it would be in the double digit, that kind of the tens of millions. But also they were able to achieve that $6 million threshold to get their name on the building. So the client was ecstatic. And again, for us, this is something that when we initially were creating the product, we left enhancement on there for, again, smaller cases, people wanting their money to go further from day one. But where we've seen tremendous success, and I'd say 9 times out of 10, we're showing enhancement. And the reason for that is you're getting significantly more recognition up front. And that can be very important for people that are making substantial gifts. But what you'll see, the downside is about a 10 basis point decrease. So it went from 5.1 to 5 on the nose, and it's $706,000 at life expectancy. So so slightly less at life expectancy, you're getting substantially more. And for these clients that were looking at getting that naming recognition, they couldn't get their dollars to that $6 million figure that they were looking for. This was a great solution for them. And it also provided them with flexibility, them being the charity in the future, and also for the donor so they could see how their money's being used through their lifetime. One last example that I'll touch through very briefly is cash dividend option. So for those charities, what we're doing here is this is the same 50-year-old male non-smoker, gift of $100,000. The difference is from day one, the charity's turning on the tap and they're going to start accumulating cash. So $100,000 is donated. That death benefit, the reason it's levelized is every year a dividend's paid. It's paid out as cash to the charity. So it's locked in at $160,000. The difference here is every year over the next 40 years, a check is automatically sent to the charity, and that the check's cumulative total is $162,000 under our current scale. So by age 90, 162 grand has been paid out. And then also the death benefit continues to be locked in at 160 grand as well. So what that means is that that living legacy is roughly about that $162,000 in cumulative cash. So the takeaway for that is really that there's flexibility in the product. This isn't something that's just designed around 40 years into the future. It's something that can meet the charity and the client's needs today, whether it be for naming recognition. And again, you might think that that's a very niche example. I've had a number of those cases, and I know my colleagues, my wholesaler colleagues across the country, there's been a number of them. They are generally in the ultra high net worth space, as you can appreciate, but there's been a number of in the millions of donation that have come up as well. So I'm just going to step through actually very quickly because I know I only have a few more minutes, a bit of a case study that will look through this. So actually, just before I step through this page here is one of the important points is how can this be funded? So I talked about cash. Another way that My Par Gift can be funded is through marketable securities. So for clients, particularly in the corporate context where they're looking at making a substantial gift, there is tax efficiency opportunity by gifting securities directly to the charity. If there were any unrealized capital gains, those unrealized capital gains, they continue to be unrealized. They don't have to cash out those securities. You transfer them in kind to the charity in order for them to use that funds either within the charity directly, or what we've seen is have them to fund the insurance policy. So as a very simple example, if you had, let's say, securities in the value of their value is $1 million and the adjusted cost base was, let's say it's, just for simplicity's sake, it was $900,000. So normally if they were to cash it out, those securities out, there would be a gain on the $100,000 difference, the difference between the million and the $900,000. So there'd be a tax cost to them. Why this is important is when you transfer securities to the charity, you can use more efficient dollars to fund the insurance product, which helps to really help from an IRR perspective as well. So that's all that's showing here is the one key takeaway is in all cases with My Par Gift, the owner is the registered charity, but the funding source can be fluid. It can be a cash, it can be marketable securities, and it could be either on an individual or corporate basis.
We got about 9 questions. Yeah, a bunch have trickled in over the course of the presentation. Some were earlier on, and I suspect you may have covered over the presentation, but let's go through them anyways.
Sure,
Tons of engagement, which is an excellent sign. So
great.
you can turn off your screen if you like, up to you. So the first one is just, does the My Par gift allow the charity to access the policy loans based on the cash surrender value?
Absolutely, they do. So I'll take it a step further. So policy loans through Canada Life, or in some cases, we've worked with financial institutions, collateral assignment too. So the charity, and I'd say this is a unique circumstance, they could go to the financial institution and use the insurance policy as leverage. So larger charities could borrow against the cash value in the policy. So yes, either
Great.
policy loans or collateral assignment is available.
Awesome. We'll
Yep,
do rapid fire for the rest just to make sure we get through them.
sure.
Say one-time insurance premium is $10,000. If personal, how much would be the 10K tax receipt save the donor in the top bracket in the year of giving?
So it depends on, you touched on it, depends on the tax rate of the individual. Using simple rates, roughly about half of that. So you give a $10,000 gift. It really depends on where their income is for that particular year, but it could be about $5,000 of that 10 that's gifted that could be used as a tax receipt to help to reduce the client's tax bill.
Excellent.
Yep.
Part of here, what's the target age group? And does the senior need to go through medical?
Yep. So I did touch on that somewhat. So 18 to 75 is the age range. I'd say target group is 50 to 65 is where we've seen success. Younger individuals, where there's an opportunity, I think, for you as advisors is have the conversation about charitable gifts. Maybe they're not in a liquidity position to make a major gift. Set up the term insurance. And as they're younger, lock in that insurability and then look at converting it out in the future. But I'd say generally 50 to 65.
Awesome.
Yep.
Leonard's wondering if the charity cashes out right away. Is there a commission hit to the advisor?
So it's a 2-year chargeback on the product. So there would be in that period of time. So yes. So again, for this, what's different around the product is because it's paid up after that single deposit, there is no ongoing servicing commissions. So it's a 4%, 4% of the premium that's deposited would be you'd be compensated on plus your bonus. But within that chargeback period, if they were to cancel the policy, then yes, there would be a chargeback. But I'd say generally, if a charity is accepting an insurance gift, if they're looking to liquidate it immediately, they would just speak with the donor and get a cash gift. So again, that's where it comes into setting expectations initially and looking at those blended gifts of cash and insurance to help them meet their needs today.
And this is more my question, Evan,
Sure.
are your wholesalers well versed on the nuance to be able to help advisors, or should they come to you with questions?
I'd say wholesalers are absolutely. If you're dealing with a charity directly and you're looking for an opportunity just to get in front of them to position the product, I'd say wholesale would be their first point of contact.
Okay,
I'm absolutely here. There's also a team of individuals, whether it be from underwriting, product tax. There's a team of people that are available to support you, but I would start with your wholesaler.
great.
Absolutely.
A few more quick ones.
Sure.
Ian gives you some kudos. Great presentation and solution. Wondering about faith-based space and how this is working there. If you have
Sorry,
any.
wondering about
Uh,
faith.
Yeah, how we're doing in the faith-based space and the best starter to position oneself as potential advisor in that space. Is there anything you've seen work well there?
I would say those that are involved already with like maybe if it's local churches or
Yeah,
local faith-based charities, that's where they have an existing relationship. But I have also seen advisors that will approach maybe their local church they haven't had a conversation with, and there could be an opportunity to speak with them. The key
yeah,
piece that I brought up before is it's worth it to take it upon yourself to reach out, regardless of the industry or charity type is they don't have the specialization with insurance. There's an opportunity for you to really position yourselves as that subject matter expert. So I wouldn't focus just on faith. All industries, there's huge opportunity with them.
how is the MyPar gift better for the donor than just giving the charity 10K?
Well, as you saw, well, the example, not the 10K, but we took $100,000 and immediately enhanced it to 160,000. Or if you're doing it with the enhancement, we're taking it from 100 to 300. That immediate estate lift is one of the big attractive points. And also for really what you'll see, people will look at the IRR, and I think I showed 5.1%. Some will say I could get that in just a traditional investment. Charities are restricted by how much risk they can take within their investments. So my part gift can be a good solution to kind of offset what they're doing currently. They need cash today, but it also can be a great solution for legacy. And I think charities, what you'll hear once you're connected with them, or maybe you are already, is they don't do enough legacy planning. It's all about today. So that's the true opportunity here is a simple product that'll benefit the client from a tax perspective today and the charity in the future.
Love that. Simple, innovative, and tailored.
Yeah.
All right. Can the client convert a portion of term to MyPar and then balance retained as term?
Yes, absolutely. And that was one of the examples that I gave earlier around you're working with a client that you think may not be medically viable if they have term insurance, or maybe you had that 40-year-old that you set up $1 million a term or whatever the amount is, you can carve out portions and then leave the residual as an individual term life contract. Yep,
Awesome. Three more.
sure.
Is the tax receipt only available in the first year on payment, or can the client elect to receive it with the estate proceeds?
Only immediately, but it can carry over for up to 5 years. So if they don't have sufficient income in that year to take full advantage of the tax receipt, it can carry over for up to 5 years, but you can't defer it. So that's kind of the exact example that I gave before. If they're looking for the tax receipt in their estate, then a traditional insurance product would be the best solution for them. Because for this, the caveat is, or the catch, has to be owned by the charity immediately. So receipting happens immediately as well. Yep.
Is the initial premium paid by the insured, or does the insured have to donate to the charity and the charity pay the premium?
I'd say by and large, individual will pay Canada Life, and then we'll send notification to the charity that premium's been paid and a tax receipt will be issued by the charity. Circumstances where you're gifting marketable securities, you would gift the securities in kind to the charity just to avoid the tax on that gain. They'll liquidate it with their brokerage. That's the example that you guys will see in the presentation that'll be available to you. So they'll liquidate it and then use the proceeds of those securities to fund the insurance. And that's the most tax efficient method. But I'd say by and large, individual or corporate client is paying Canada Life directly, and we're working with the charity to receipt it out.
Good stuff. We'll leave it there, Evan. That was exceptional. And judging by the number of questions, the audience is clearly engaged, and I suspect we'll make some progress on that key action that you asked, which is getting more advisors in this philanthropic space. So thank you. Thank you for this presentation, and it's a great opportunity. Speak to your local Canada Life representative, and then they'll, of course, bring in Evan where required.
Fantastic. Thank you.
Thank you, sir.